Okay, in this video, I am going to teach you about the effective interest method. So when we were covering the interest payments and we were amortizing the discount or the premium, we were saying it was kind of like a three-step process where we would record cash payment first, right? The interest payment. So it's the interest rate times the face value of the bond. And then we would amortize the discount. We would take the total discount divided by the total number of periods. And then we would sort of use the payment, the amortization of the discount, and then we would back into the interest expense. Okay. And we called that, I don't know if we called it or not, but it's referred to as the straight line amortization method, meaning we're going to calculate interest using a straight line, and it's going to be the same interest expense every period. Now, an alternative way to calculate interest expense when we pay interest on our bonds, we could use what we call the effective interest method. And the effective interest method is going to be an entirely different approach, okay? So before I dive into PowerPoint slides, or my drawing, I'm going to try to, okay, never mind. I'm not using the PowerPoint slides. Using the effective interest method, the first thing I'm going to need to do is create an amortization table. And an amortization table is going to look like this. I'm going to have a beginning balance, and that is either the issue price of the bond or the ending balance from the previous period. Okay? Then I'm going to have interest expense. And interest expense is always going to be the market rate times the beginning balance. All right. I'm going to have interest payment. And my interest payment, we already kind of know, that's going to be the face value times the stated rate. All right. Then I'll have amort of discount or premium, depending on whether we issued it at a discount or a premium. And that is going to be my interest expense minus my interest payment. Then I'm going to have finally ending balance. And that will be beginning balance plus my interest expense minus my interest payment. Okay, let's do this. Let's start with what the slide is telling us. Period 1. What's the PowerPoint slide telling us? Okay, we are issuing a bond, right? So we're issuing the bond for $96,400. We just learned how to do that, how to calculate the calculate the issue price. That was all of these nonsense slides from the previous video. Don't panic, okay? But now we are going to figure out how we do the journal entries for interest expense, interest payment, and so forth. It's down here, but I'm just going to walk you through it with my slides. All I'm coming here for was to get the issue price, $96,400. So I'm going to start with $96,400. Now I want to do interest expense. And the interest expense is going to be based off of, again, the market rate. And remember, we said the market rate was, according to our previous slides, the market rate was I can't fucking read that, 5.0155. with me. I'm just going to write it up here. 5.0155. So 96,400 times 5.0155. Remember, the market rate was 10.3 something. But again, that was an annual rate. We cut it in half in order to pay semi-annually. So I'm going to do 5.0155 times 96,400. I'm coming up with 4,835. I rounded out. All right, our interest payment, that was, going back to the slide, pretty sure the stated rate, okay, again, the stated rate is 8% based on all the assumptions that we were saying. So the bond is a face value 100,000. The stated rate is 8%. It matures in 2 years, and we're paying semi-annually. It's been the same bond for quite a few videos now. Okay, so going back to I'm going to say my interest rate is 4%, right? And therefore, $100,000 face value times 4%. Again, it was 8% semi-annually. My interest payment is $4,000. The amortization on the discount, I'm going to eat into the discount $835. That's the difference between the interest expense and interest payment. And now my ending balance, right, is obviously going to go up. My ending balance is going up because we're saying, listen, my interest expense is $4,835. However, I'm only paying $4,000. So I'm not even paying what I'm obligated to pay. And therefore, I need to add the difference to the carrying value. So 96,400 plus 4,835 in interest minus $4,000 payment is going to give me, bear with me, it's going to give me 97,235. I don't know what this is. I have no idea what that is. Okay, then the second period, I'm going to start with 97,235. My interest expense will be 97,235 times 0.050155. And I'm coming up with 4,877. This is never going to change. It's always going to be 4,000. And then the difference between my amortization on my discount, the difference between my interest expense and interest payment is going to be 877. And therefore my ending value is going to be, bear with me, 97,235 plus 98,112. And then if I were to do this for year 3 and year 4, I would get all the way down to the ending balance of year 4, and I would have $100,000. I bet you if I go to the PowerPoint slides, that's what the PowerPoint slides are going to show me, right? Again, their columns are different. The columns are different, but they have interest paid, and that was the face value times the stated rate, just like in my table. They have interest expense, and that's the carrying amount or the beginning balance times the market rate, just like mine. They have the discount, right? Or the amortization of the discount, meaning we're just eating into the discount by some amount, same as mine, right? And so they have period 1, 2, 3, 4. Okay. So that's the table. And then we could use the table to do our journal entries, right? So the first payment of 4,000, right? 6 months out, I'm just going to go pull all the information I need from the table, right? So first, my bond interest expense, an expense lowers my equity, therefore it's going to be a debit. And I'm pulling it straight from the table. My interest expense in the first period, 4,835. So I debit 4,835. Second, my amortization on the discount is a credit of 835. And think about it. Remember, if I issued it at a discount, right? The discount has a credit balance of 3,600. The discount is a contra liability account. I'm killing myself. I messed that up. The discount is a positive amount. The bond payable is credit. Okay? So I'm going to lower the discount every period and I'm going to pull it from this column. Right? So if I wanted to lower the discount, I would credit the discount in this first year by 835. And then we said the cash payment, it's just the face value times the stated rate every year. And so I can keep doing this year after year after, sorry, not even year after year, but period after period. I can do it for the second month, man, the second period, right? My interest expense, it's not going to be 4,835. It's going to be 4,877. And then my discount, it's not going to be 835. It's going to be 877. And then the interest payment, that will always be 4,000. Okay. That is the effective interest method.